Hello and welcome to BloombergQuint. The Reserve Bank of India's annual report came in today. The announcement of a large surplus had come in a few days back, but we know a little bit more about what went behind that surplus. They've transferred a little more than 99,000 crore, more than what the market was expecting to the government. Joining us to talk about not just the number, but some of the principles that may have impacted the surplus transfer are Gandhi, former Deputy Governor of the Reserve Bank of India. So very kind of you to speak to us here.
Good evening.
So let me start with first things first, and then get into the nitty gritty. So I think what has raised eyebrows, or raised interest at least, is that the surplus transfer of 99,000 crore was far larger than what the market had judged based on purchases of government securities, etc. And today in the annual report, it turns out that the RBI got a large chunk of earnings from FX transactions, in particular FX sales, because they have made an accounting change a few years back to benchmark these sales to the historical weighted average cost of their foreign exchange that they have bought. First, sir, what have been your thoughts on this change in accounting, which is actually not new? It happened a few years back.
Correct. Yes, as you said, that accounting change had happened a few years before. And this time also, its impact is not large as you all think. If you look at the schedule 14, where it gives the breakup of the other income, which indicates earnings from the foreign exchange transactions, that is sale of securities, the gains from that and other thing, you'll find that the income that has come out of that particular source, it is hardly 20,000 crore. It's not large. So it is very, very, very small compared to the total revenue that Reserve Bank has got and that transfer that Reserve Bank has made to the government. So out of 99,000 crores, if at all, you can say that this particular accounting change related contribution has been only 20,000 crore. So
sir, am I reading this wrong? Because so in that column, in that schedule itself, where they're giving different sources, the total interest that they have earned, other income they have earned. So right. For FY20, the exchange gain for FX transactions was 29,993. And for the July to March period, it's now 50,629.
Yeah, the increase I'm talking about. The increase between the last year and this year, it is hardly 20,000 crore.
Okay.
Right. So we have to factor in this year, even though Forex reserves have been increasing throughout the year, but the Reserve Bank had to intervene in the Forex market quite often because especially immediately after the COVID impact period, there has been quite a bit of intervention by the Reserve Bank of India. They sold a large amount of dollars. So when you sell dollars, whether it is cash or securities, typically securities the Reserve Bank will be selling, that would mean that it would gain a kind of capital gain out of those sales. That is what this 50,000 crore represents. Okay. Right. So the previous year 30,000 crore, and this year the current period which has closed, it is 50,000 crore. So the net increase is 20,000 crore. Right. Okay. So that's why we should not be thinking that as if this particular change in accounting policy has resulted in such large increase in the net surplus. Net surplus is a combination of that has been arrived at after factoring several other income and expenditure. This contribution, as I mentioned, it is hardly 20,000 crores out of the 1 lakh net surplus, 1 lakh crore net surplus.
Sorry, help me understand this, sir. I'm a little confused. So I understand that the increase is only about 20,000 crore compared to last year. But in computing this year's surplus, standalone, the 99,000 crore, not comparing it to last year, there are two major contributors. One is this, which is the exchange gain from FX transaction, and the second is the large drop in expenditure, which comes because they have transferred a far lesser amount to the contingency fund.
That's right.
So would it not then be fair to say that this was a material contributor to the surplus, not the increase, but the 99,000 crore surplus?
No, because that way, if you look at the total income, that has been accounted by the interest income, that is 70,000 crores in this 2021, and other income is 64,000 crores. Out of the other income, 64,000 crores only, this 50,000 crore contribution from the Forex realization of Forex related gains have been accounted for. So out of the 1,33,000 crore of the total income, 50,000 crores have come from the Forex capital gain related. Yes. So that is about 1/3 of the total income has come out of this particular type of operations of the Reserve Bank. Yes.
Oh, okay. So before I get to the numbers, so the accounting change, the Jalan committee had okayed it, but it had actually been recommended earlier by the Maligram committee, if I'm not wrong. Please correct me if I'm wrong. I just want to understand from you. Now the accounting principle is solid, that you're selling right now, you benchmark it to your historical cost of having accumulated Forex over a large period of time. But surely the RBI knew this, but for a long period of time, they continued with a far more conservative principle, which was benchmarking the sales to the weekly revaluation rate. Can you help us understand why that conservatism had been retained in the RBI and what you think of the principal shifts?
Right. Actually, RBI was not happy in moving towards this particular way of accounting. RBI wanted to be conservative, but the international accounting standards and Indian accounting standards prescribed that whatever is the capital gain out of the long held assets, whether it is foreign currency assets or domestic assets, Reserve Bank should be by explicitly bringing in through P&L, and any transfer it want to make to the reserves, it should be through the P&L. So that is the new accounting principle, which have been not new in the sense that it is new in the sense that in 2000s it had come. But Reserve Bank has been resisting to move to that kind of standards all along, saying that as a central bank, we would like to be very conservative. This income which should not be distributed in principle, it should go to shore up its reserves. So that was the rationale by which Reserve Bank was resisting from moving to this particular way of accounting. But as I said, that international accounting standards, Indian accounting standards, auditors went on insisting that Reserve Bank should move into this new principle. And finally, it was granted in 2016, if I remember. So 16-17, it was agreed that, yes, we'll move towards that. So that's why it is not that Reserve Bank just to gain this kind of profit in the P&L account, it wanted to move. It is the accounting principle followed across the world.
Understood. So one of the issues that comes up in this, and the market has been grappling with it, is that the RBI doesn't disclose this historical weighted average cost, does it? I mean, and if it doesn't, why don't they disclose it? I know it would change day to day, but surely some sort of benchmark can be provided to the market.
It is not for the market, right? It is for the auditors to check. Auditors do check that, and whatever is the gain out of that is properly brought into income account. So, what is the point in disclosing to the market? I'm not at all clear about the rationale why such a information will be required by the market. What is the holding cost of the dollars or any other asset that Reserve Bank would be having? I don't think in any way it makes sense for disclosing that. I am not aware of that argument at all.
What are the risks of disclosing it? I mean,
no, it is not. What is a risk?
No, in disclosing it, I mean, if the if the market is aware what the weighted average holding cost is.
Because it is a multi-currency asset, so it is not easy to bring in that kind of information. In what way it is helping the market, I'm not aware. Because when you say that some information should be disclosed, that it must be relevant to the market, not just because somebody wants it.
Okay. No, I think they're just saying that then it's easier to determine what kind of dividend would emerge out of sales. But leave that aside, sir.
No, dividend will come if Reserve Bank realize in a way that information is available. If you look at the CGRA.
Yes, sir.
So that is a unrealized gains or losses which Reserve Bank makes on its assets.
Yes, that's not.
So that will be an indication, indirect indication. What's the kind of profits Reserve Bank can make should Reserve Bank sell these assets and realize that particular gain. So that is already available there. But how much it will sell, that depends upon its Forex intervention operation. That can never be predicted, right? How much dollars it is going to sell, and in the process, it is going to realize capital gains. So that is not easy.
Understood. Actually, that is the next point, sir. And I'm just putting this point across to you. You would be best placed to answer. Now, if you looked at this year's forex sales and purchases from the Reserve Bank of India, a question is being raised as to why the RBI had so much both sales and purchases in the January to March quarter. On the face of it, it's difficult to see very sharp volatility. There wasn't, that kind of volatility that would require very large sales and then very large purchases. So a question is being raised, was the RBI doing this to generate more dividend?
This is a very, very far-fetched, imaginative way of questioning or commenting on Reserve Bank's operation. Just to make a gain out of the transaction so that it can transfer much higher value to the government. If that is what is the underlying assumption here, I beg to differ. Because the Reserve Bank never does anything based on the ultimate results of the operation, whether it is going to be profit or it is going to be loss. Its operations are always guided by the monetary policy, number one. First, always guided by the monetary policy, liquidity operations related that. Number two, in Forex, it has always maintained that it doesn't have a rate fixation. It is only to manage the volatility. Volatility, how you determine? You are trying to argue post on the basis of hindsight that after the event is over, the argument will be, and if had the Reserve Bank not intervened that way during this period, as you say, between the last quarter of the last year, that much of buying and selling, had it not happened, then volatility would have resulted in. So that counters factual is not very clear. So that we have to, it is easy somebody to argue that just to transfer large surplus, Reserve Bank did it. That is, I don't think such a institution which has got such a high credibility, somebody is doubting like this.
No, absolutely, which is what sort of brings me back to the original point that I was talking about. So, they say that Caesar's wife should be above suspicion or whatever, and the central bank should be above suspicion. So now, having accepted this accounting change, do you think there is a little bit of onus on the RBI, or not onus, or should the RBI become a bit more transparent about its FX policies, just to quash all of this kind of speculation? Because I can tell you, sir, the speculation is there in the market to the extent that, in the January to March quarter, the RBI will be selling more because, there is a profit motive attached. The speculation is that they will do more sell-buy swaps because, that way they can generate money. That speculation exists. Is it incumbent upon the RBI to then be more transparent?
I only wish that these commentators I only wish that these commentators had supported Reserve Bank when it long had been arguing that conservative policy of income-related principles should be followed. At that time, nobody was on the side of Reserve Bank. Everybody went on saying that accounting principles, international standards should be followed. The Reserve Bank went on telling that this kind of excess, if it is retained in the Reserve Bank to strengthen its balance sheet, that would have been good. But nobody listened. These same very commentators, why they were not making a simple comment about this all this time at those times? Now they are saying that by following a internationally accepted accounting principle, the government is getting large surplus. Then you start questioning or doubting the intentions of the Reserve Bank. That is a very, very fair point.
Fair enough, sir. So let me also ask you. I mean, so as this money gets realized from sales, the mirror image of this is on the CGRA, that the CGRA doesn't build up as fast or depletes a little bit. Is that a fair date? No.
No, CGRA has nothing to do with the actual operation. CGRA is based on the currency value movements, Indian rupee versus dollar and other international currencies. So based on that revaluation of the assets, by the CGRA gets built up or depleted. So that is nothing directly with the actual operations of the Reserve Bank of India in terms of selling or buying securities. Selling and buying securities, the resultant result will be onto the P&L itself. It won't be affecting the CGRA.
Okay. Sir, there is
CGRA is unrealized gain or unrealized loss.
Understood. And if you look at the level of CGRA and the level of the realized equity, I think they've maintained the minimum threshold that the Jalan committee had set. Although the level of CGRA, sir, has been coming down a little bit. It's now 15% of the balance sheet versus about 19% a few years ago.
CGRA, there is no percentage prescribed by the Jalan committee because that is actual. Yes. That based on whatever is the revaluation gains or loss, that gets parked in the CGRA. That may go up, come down based on the, as I said, in the exchange rate movements of Indian rupee vis-a-vis other currencies. So that has been the argument at that time, that CGRA will be as given, as accounted. So that will not be touched at all. Beyond CGRA, the reserves should be between 5.5 to 6.5% of the total balance sheet.
And we've stuck to, or the RBI stuck to 5.5. That's a decision, I guess.
Yes, because the Jalan committee had given that range. It has not given a specific number, 5.5 to 6.5. So that is why when it was first brought out 2 years before itself, I did mention in one of the reactions that, yes, as a central bank, we would always like the number to be 6.5. As the government, but they would always like, they will feel that 5.5 is sufficient. So between 5.5 and 6.5, it is a question of negotiation between both the parties every year. What is given the particular year's compulsions that they may decide. So in the current year, having faced COVID-related impact both on the revenue of the government and on the expenditure also, then I can easily understand why 5.5 was thought to be okay.
Okay. So the slightly lower transfer to the contingency fund compared to last year would basically be linked to how much the balance sheet has grown. Last year, the balance sheet growth was more than this year.
It's not. You should not see as if the amount transferred 20,000 is insufficient. The point is about the contingency reserves should be at 5.5% of the total balance sheet. Okay. To reach whatever is the number, whether it is 20,000 last year, look at the last year figure. Last year figure is very high.
Very high, yes, sir.
Right, because to maintain that 5.5 last year, that much of high transfer was required, and it was done.
Okay. Understood, sir. So there's one other sort of side issue, not directly related, but maybe it could be. Is this issue of forwards book? I think the RBI has built up a very large forwards book. Both last year and this year, they have booked losses on that forward book. I'm not sure what to read into it, if anything.
See, out of the various instruments or tools the Reserve Bank has for Forex intervention, forward operation is also one, right? So it is not that the Reserve Bank has to intervene in the Forex market only on spot basis. It can do it on forward. That's what it has done. And very recently, it has added further tools also, or instruments like repo, Forex repo, and reverse repo. That's another type of instrument which has been added. As a situation demands, the different type or new type of instruments have been applied by the Reserve Bank of India. So that way, Forex is also, forward is also one of such instrument. That's why we should not read too much as if something is hidden because of forward or nothing. It is not like that. That's why in Forex operations, in forward operations, sometime it will be net. It will have an desired impact on the rate in the market to bring stability, but it will be cash neutral for Reserve Bank, because it would always mean selling and buying back type of. So the net impact on the reserves will be zero, but desired impact on the rate in the market has been achieved. So that the Reserve Bank always factors in this kind of possible impact. On that basis, it decides on a day-to-day basis what should be the right tool to be applied on that particular day.
Sir, is there any, sort of not number, but is there a balance that the RBI tries to maintain between domestic assets and foreign assets? And does that in any way guide your decision to intervene via forwards or via spot?
Not at all. There is no such yardstick or benchmark. How much should be the FCA vis-a-vis domestic assets? As I said, it all because please remember, Forex is autonomous flow. That Reserve Bank does not have much of a control there. Whereas by liquidity operation, Reserve Bank will have a greater control in the sense that it can predict what's the kind of liquidity that should have and how much should intervene through operations, domestic asset-related operation. It is easier to manage. But Forex is always given. That is a Reserve Bank role comes after the Forex comes in or Forex flows out. So that's why the Reserve Bank can never be, not only Reserve Bank, typically any central bank, they will not have any benchmark that how much of foreign currency assets should be there vis-a-vis the domestic assets.
So the determination broadly would be on domestic liquidity conditions and perhaps volatility in the FX markets. And
that's right. That's
okay. Sir, a slightly completely unrelated issue, but one number which also comes out in the annual report, which is always of interest, is the share of high currency notes. I think it's heartening to note that over the last few years, the share of 2,000 rupee notes has been coming down. I think there was much criticism post demonetization that what's the point of adding another large value note? This is as per your expectations, sir.
Yeah, because please remember that during the demonetization time, the introduction of 2,000 rupee denomination was a very, very hard decision, very difficult decision to do that at that time. Because fundamentally, it works against the principle of demonetization. Demonetization of the higher denomination was the theme, and we are introducing another still higher denomination. That time it was required because otherwise the time required for printing large amount of 500 rupee notes, that much of capacity and waiting period was not possible at that particular point in time. That's why as a tactical decision, it was taken that 2,000 rupee notes will be introduced. So that's why it was very clear that we are unlikely to continue to print 2,000 denomination because it won't really be useful to continue. And as we saw in every year after year, no further 2,000 rupee notes have been printed, and whatever has come back to from the circulation to the Reserve Bank of India, Reserve Bank has just kept it and not reissued.
True. So as this sort of process continues, assuming they will not be printing any new 2,000 rupee notes, do you think it's okay for 500 to be the peak denomination for India, or there's been much debate whether 1,000 needs to be reintroduced?
There has always been arguments all along that as the economy grows and the inflation impact is there, higher and higher denomination notes will be needed periodically. That's a standard principle all along we have been following. But recently, two specific developments have taken place. That's what has come will compel us to rethink on this long-held wisdom. One is that digital transaction has now come to stay, and large value transactions today through digital means it is happening, and that is and increasing also year after year. So that automatically means that lesser and lesser cash currency notes may be needed, and in addition to not just the absolute number of currency notes, even the higher denomination notes need not necessarily be available. Because the earlier argument was that for transactions you will need higher denomination notes. That used to be the argument. That today we have an alternative in terms of the digital transaction. That is the first development. Second development, the inflation. Because again, as I said, that India had been an inflationary economy all these years, but post MPC in the last 5-6 years, we have established that low inflation will be possible to maintain on a sustained basis for longer years. So when that is that has now been demonstrated, going forward, inflationary impact on the value of the rupee is also going to be less and less. That also means that higher denomination notes need not necessarily be brought on in the same frequency as we used to have in the previous regime. So that's why a combination of these two factors, inflation, low inflation has come to stay, and digital transaction have taken a big leap. So in that process, we may not necessarily need to introduce higher denomination notes in the same set of like a previous period.
So just as the last question, I'll come back to the issue we started with. I know you've rejected, outright any question of the RBI sort of trading, to generate profit and then pass on surplus to the government. But you can't deny, sir, that over the last few years, there's been just too much questioning or, pinpointing at the RBI's surplus, linking it to the government's fiscal position, which has been weak for the last few years. Is it incumbent upon the central bank to sort of put an end to this speculation, to be more transparent, to, sort of divorce its surplus and dividend decisions from the government's fiscal, or is that utopia that, it will not happen?
That's what should happen by the Jalan committee. Because of this particular question that was being debated across, we brought up an expert committee headed by Dr. Jalan, which prescribed today a clear formula of what should be, how that surplus should be determined, and so long as this kind of reserves have been maintained, anything beyond that, it is for the government. So that's what is being followed. Number two, and this high surplus transfer, it is not recent phenomenon. Almost from 2013 onwards, year after year, we have been transferring a very high surplus to the government, because over the period, all these 70 odd or 80 odd years, Reserve Bank had been transferring very less surplus to the government, retaining a lot as reserves. So that large corpus, which has built over these years, that is sufficient now today by this yardstick. So that's why we should accept the position that either we should disagree with this Channel Committee report of recommendation of 5.5 to 6.5 is insufficient. In that case, somebody has to put an argument, theoretical argument, why that is insufficient, and then what should be the number. They should come forward, and then there can be a debate on that new number. So long as there is no such counter argument, we should agree to the position that so long as the surplus reserves are maintained at between 5.5 and 6.5, any surplus should go to the government. That we should agree.
And same with the accounting change. We've gone in that direction now. The consequences of that will...
Again, it is international principle. Everybody, all institutions, all commercial institutions, all financial institutions follow that method. Only Reserve Bank was not following.
Okay, understood. Mr. Gandhi, thank you as always for your clarity, and thank you for speaking to us.
Welcome. Good.
Thank you for watching Bloomberg.
Bye.